Hello everyone, in this video we will be going over A-Level Accounting 2023 February-March paper 2 question number 3. So this is a structured paper 2 which consists of 4 questions. 2 of them will be of 30 marks and 2 of them will be of 15 marks. And we're also given a total time limit of 1 hour and 45 minutes. Since question number 3 is of 15 marks, ideally you should be spending about 17.5 minutes in order to complete this question. And in this video as well, we will be attempting to solve this question under 17.5 minutes. And I'll also link the question paper as well as the mark scheme in the description box below. So without any further delay, let's get started. Hania wished to compare some ratios for her business. The following information is available for the year ended 30 November 2021. Alright, the following extract was taken from the statement of financial position as 30 November 2022. So this is of last year, since this is the date of 2021, whereas we're talking about 2022 in this case. So this will be our current year's values. Now, for the year ended 30 November 2022, credit sales totaled 94,800, whereas credit purchases totaled 88,300. Now, we just need to calculate each of the following ratios for the year ended 30 November 2022. The first one is asset test ratio. So, the formula for asset test ratio is just current assets minus our inventory divided by current liabilities. We're given the current assets right here, and the total is 27,350. We have our inventory right here, which is of 11,500. Then we have our current liabilities right here. The total is 18,300. So this just gives our asset test ratio to be 0.87:1. Now the second ratio is trade receivables turnover in days. And the formula for this is just going to be trade receivables divided by our credit sales times 365. Now trade receivables is given right here. That's 9,600. We were told that the credit sales total 94,800. Times 365. This results in 36.96, but since we're talking about days, we need to round it off to a whole value. So that's going to be 37 days. Now we also need to calculate the trade payables turnover in days, and the formula for this is similar to trade receivables turnover. So this is just going to be trade payables divided by our credit purchases times 365. And we're given the value for trade payables right here, that's 6,580. Our credit purchases is given to be 88,300. So let's substitute these values. That's going to be 6,580 divided by 88,300 times 365. And this results in 27.20. Again, we need to round it off to a whole number. So that's going to be 28 days. Now for the second part, we need to explain the importance of the asset test ratio to a business. So asset test ratio basically compares our current assets to the current liabilities, which means that it helps measure a business's ability to pay its liabilities as well as running costs, but in the short term, since we're only comparing the current values, right? But since this also excludes inventories, this will be the ability to pay those running costs in the short term without liquidating its inventory. Let's write it down. Measures businesses abilities to pay its liabilities and running costs in the short term without liquidating its inventories. Okay, now for the next part, we need to identify 2 ways in which the owner of a business could improve the asset test ratio. Okay, so the formula is current assets minus inventory divided by current liabilities. So for this ratio to improve, either this factor needs to increase or this factor needs to decrease. So let's have a look at our current liabilities section. Okay, we're given bank loan. So instead of taking bank loan as a current liability, if we were to take a non-current liability, then our current liabilities would have been reduced by 10,000, which would have improved our asset test ratio. So the very first way in order to improve our asset test ratio would be to borrow more long term. So borrow more long term. And for this part to increase, we just need to increase our current assets and decrease the inventory, right? So let's have a look at our other current assets. We have trade receivables and cash at bank. So in order to increase the total current assets minus inventory, we can just increase our cash holdings. Let's write it down. So we can write it as investing more capital in the form of cash. That's all for the second part. Now for the fourth one, we need to discuss the changes that have occurred in the trade receivables turnover days ratio and the trade payables turnover days ratio for Hanya's business. So let's first talk about our trade receivables turnover. Let's have a look above. We have our previous trade receivables turnover days to be 34, and the new one we calculated was of 37 days. So the days has definitely increased, and since we're talking about trade receivables turnover days, this just means that the days in which we would get the money from our credit customers has increased. So this definitely worsens our liquidity position of the business. Let's write it down. The trade receivables ratio has worsened, reducing the liquidity So if it's taking a longer time for us to receive the money from our credit customers, then this might mean that there's a higher chances of irrecoverable debts. Let's write it down as well. There could be less control over credit customers, leading to irrecoverable debts. Let's talk about trade payables turnover. Let's have a look above. The previous ratio was of 36 days, whereas the new ratio is of 28 days. So the number of days has decreased, and since we're talking about trade payables turnover days, this just means that the number of days in which we repay to our supplier has now increased. So we're repaying faster than we used to did before, which again means that the ratio has improved, which will reduce the liquidity of the business. Let's write it down. The trade payables ratio has improved, but this will reduce the liquidity. But since we're paying at a shorter period, this just means that we might attract more discounts, which could improve our profits. Let's write it down. This may attract more discount receipts, improving profits. Let's also write down one point regarding the overall liquidity of the business. So we can see that we are receiving money at a later date while we're paying money at a faster rate. So this might create some of the liquidity problems. Let's write it down. Credit customers now pay more slowly than the business pays its trade payables, resulting in possible liquidity problems. Alright, this concludes the fourth part as well as the entire question number 3 of 2023 February-March paper 2-2. If you found this video useful, make sure you like the video and leave a comment below, and make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.